Hey there, everybody. I'm Leah Collich, an investment counselor here at RealWealth. And as many of you know, we are working daily kind of behind the scenes to find out, what's happening in these 18 or so different markets that we're investing in, but we're also talking with experts in the space. We're daily communicating with our preferred lenders, CPAs, attorneys, to really keep our finger to the pulse on what's happening in our industry and what are the impacts to you, the end user, the investor. So today I hopped on a call with our preferred lender, Highlands Residential. Many of you recognize the face here on the screen. Graham Parham spearheads that team. We come to Graham all the time to just get updates on what's happening. And we wanted to hop on a call today to just chat through the Fed's latest announcement yesterday, but also to understand what can we be expecting in our rate locks over the next week, month, if we can predict that far out. So again, I'm joined today by Graham Parham. Graham's brought two of his work counterparts. So Graham, would you introduce who you've brought with us on the call today?
Sure. Aaron Stelly is my production partner. He's been with me for about 7 years. He pretty much is in the trenches every day with me. And then Andrew Stringer just started as our vice president of capital markets. He's the guy that basically finds money, sells the loans, prices, the whole 9 yards. So he's kind of our expert today to kind of talk about the rates and the challenges that investors are having, and also understand the reality of where we probably are going to be, within a year from now or so. But yeah, that's Andrew, and Andrew's going to try to give us a deep dive on what he knows, and I'll just give you my opinion for what it's worth, and we'll go from there.
Awesome. So what kind of triggered this conversation, Graham? Every week I usually reach out to you to just say, hey, where are rates at? Because we want to make sure that our performas are staged with kind of an accurate projection, which arguably has gotten very difficult to do lately as interest rates have been pretty wild all over the place. But Graham, we were emailing back and forth, and you're like, Leah, let's just hop on a call. There's some details here that I want to be able to kind of anecdotally explain. So I want you to kind of recap what you and I talked about when it comes to, what are our investors seeing today with rates beyond just price of where they're at, but like the volatility, the points, like where are we at?
Well, I have to go back in time to talk about some of the loans that were originated, say 17, 18, and 19. Okay. And the investors off Wall Street that bought these mortgage-backed securities, when they buy them, they like to keep them on their books for 3 to 5 years so they can make some money on them. Well, what happened to those loans when COVID came around in 20 and 21, the rates hit the bottom, everybody and their mother refinanced their loans. The guys on Wall Street was hoping to make some money on those loans, and they had to deal with a thing called EPO, or early payoff. Okay. And that kills their margins. And so what happens is, the Feds right now, they're increasing the rates, or Fed rate, which ultimately increases the interest rates to the point of where we are today. But as they do that, this inflation, they're trying to slow down, and eventually we're going to hit that recession wall. And once that happens, the recession typically will soften up those rates, and they'll come back down again. So my prediction, and Andrew's going to give us his prediction, I say a year from now, we'll probably see the rates come back down. Other analysts that I've listened to on a daily basis, they say next year's average rate could be, 5% for owner-occ across the board. I'm hoping that's true. But the fact of the matter is, Wall Street knows that it's going to happen. They know they're going to get EPO, and they're trying to avoid that more margin loss, okay? Which means that, why can't I get a loan today at 0-point pricing? Well, I've been in this business for 25 years. I've never seen it like this. We always get 0-point pricing. And because they're not giving as much margin to these loans, as an example, we have to sell a thing called par rate. Let's call par the price. And I'm at 100.00. That's what we have to price it at. If somebody wants to buy the rate down, okay, well, they can. And then it goes down to like 99. Well, they're going to have to pay a point to get to 100. Okay. So those additional margins that they're not giving us, because right out, they give us 30-year fixed rate right out of the box, it has so much margin. And then we have to make adjustments to it. What kind of credit score, what kind of property type, what kind of loan amount, what kind of percent of down pay, all those factor into it. And really right now, the going practice is probably at 25% down to get your optimum rates and terms. The 20 gets really challenging because the adjustments on the 20 is more than double than it is on the 25. But even at the 25, there's lack of margin. A lot of times you're having to come to the table with a point and a half to get to 100.
Yeah.
And that's where people don't understand it. And that's why I'm trying to explain it today. It's not us, it's Wall Street. They're being cautious and they don't want to lose their margin on these early payoffs.
Right.
And with that, I'm gonna kind of turn it over to Andrew. He can elaborate a little bit more about his opinion on this.
Yeah. Just that last tail end part, it's not even Wall Street. You have the investors that we deliver these loans to. They're hedging their bets also. So you're getting kind of double dipped.
Yeah.
You're getting not only the Wall Street, the security owners or the buyers of those securities, but you're getting the middleman, if you will, of the investors that we sell to in the secondary market, as they say. They're also holding back themselves because they believe that they don't want the risk. They don't want to have the EPOs. And then that's passing through even less pricing by the time it gets to us. So it really is a double whammy.
So everyone is expecting rates to come down, and these points that they've built in, it is really their way to kind of mitigate future loss, knowing that rates are going to come down and everybody and their mom is going to go back and refinance again. That's kind of their motive here.
Right. What we really need now, as Graham mentioned, I mean, the idea of the timeline from when we finally get a neutral or a nominal state of where the Fed holds the Fed fund rate for a prolonged period. What we're looking for, maybe if it's not lower rates, just stability. The longer we get performance in these higher note rates, those security owners or the buyers that are out there holding the securities, they're going to get more comfortable with the prepayment speeds. The problem is we've gone so far, so fast that these securities and the 7 or 6.5 coupons, they're not proven. We don't know obviously what the future holds, but more importantly, there's no track record to show what is the behavior of a customer holding that type of interest rate going to prove out. And those securities are being priced based on that lack of liquidity and lack of performance.
Interesting. So I guess we're doing exactly what they think we're going to be doing at RealWealth. We're kind of starting to tell people, like, think about the refinance in your future, right? Don't sink a bunch of cash into a property now. Don't, maybe reduce leverage, too much, knowing that the plan is to refinance in a shorter period of time anyway. So they're kind of right about kind of speculating what our behavior is going to be. Your industry has been on quite the roller coaster ride. It's probably an understatement over the last maybe 2.5 years now. Andrew, we were discussing kind of volatility and trying to understand like what's driving some of this volatility. And you had a great table that you wanted to kind of show for us. I'll give you control here so you can pull that up and kind of talk us through what you're seeing in rates today.
Sure. All right, I'm going to pull this up here. There we go. Okay, so I'm going to do my best to kind of give you an understanding of what you're seeing here. This is broken out by different segments. These are interest rate tranches. So the top used to be in the, call it 3 and 3 1/4 range, all the way up to current market, which is our bottom tranche. And you'll see the spikes, which equate to volatility. Now, what this is measuring is a 14-day average of the price movement from the open to the close, top to bottom. And so when you think of it in interest rate form, every, call it 50 basis points, averages about 1/8 in interest rate. And so in my side of the world, everything is measured in 30 seconds. But I drew these yellow lines that show where we currently are, which shows about to be 100 or 31, which is about 100 basis points, 31, 30 seconds. 32, 30 seconds is 100 basis points. So what I'm showing you is, on average, intraday, we're seeing as much as 100 basis points in movement, which equates to about 1/4 in rate. That can shift. You start the day at 7.5. It could be 7 3/4 at the end of the day. That's the extreme volatility we're seeing. And you'll notice, again, this is kind of current market where the lines stop. But if you go back about 2020, you'll see that huge spike happened when COVID hit. And if you go back beyond that, even to say 2013, that was when Bernanke and the taper tantrum occurred. You can see these moments in time where the volatility entered in. But in between those spikes, the movement was close to about 830 seconds, which is about a quarter in price. So half of an interest rate movement in a given day. And so what this is just trying to illustrate, again, this is a 14-day average, how much in 2020 the volatility is ramped up. And then going back to when we were talking about investors holding or wanting to buy paper, bonds, or securities for mortgage backs, I mean, it has to be, there's so much liquidity on the sidelines because it's just hard to play in this environment. It's very expensive. And so I'll kick it back to you, but I just thought that was important. Again, when you're a buyer looking to try to make a decision, it really is here today, gone tomorrow.
Yeah, this illustrates a really good point that I want to make sure people are paying attention to, because I've been hearing this a lot. People are watching, a webinar that's maybe a month old or 2 months old or even 6 months old, and they're looking at the rates that were used a month ago, 2 weeks ago. And to your point, Andrew, I mean, we could record a webinar yesterday and had a good quote, a good estimate on what rates were that day. And the very next week, that rate is long gone, better or worse. So I've been urging people, you have to firm up your own pro formas, maybe often as you are analyzing deals and deciding the properties that you might want to put under contract. If you haven't connected with a lender in preparation for contracting a property, you need to be, so that you can, stay connected to how, volatile these rates are and how it impacts the bottom line. Graham, I bet you're seeing some of that on your end, people who've maybe contracted properties months and months ago with one expectation, and then it comes time to lock their rate, and wow, the numbers are vastly different than they anticipated.
Yeah, some of your newbies, if you will, they don't understand that you're buying an investment. Okay, they were anticipating cash flow. We all are, and we are going to improve that cash flow. Maybe not today, but maybe a year from now. With the refinance, with the increase in rents, and so forth. So we're making the right decisions on these properties. Leah, you're buying still, I'm buying still, and most of the savvy investors out there that's a part of your group are continuing to buy. Mm-hmm. The newbies sometimes are a little nervous. They're still sleeping on the COVID rates. Well, that's where I thought we were going to be. It's not that way anymore. But I do have a question for you, Andrew. I noticed today when I looked at the pricing that we only really went up about an eighth in price, or eighth in rate. So we, a lot of people are expecting, well, why didn't we go up even higher than that? And is there a lag time that Wall Street is going to delay that increase? Give me your thoughts on that.
Yeah. So we got the Fed meeting that happened yesterday. If you read into it or watched it or have learned about it at this point, the 3/4 hike was received as expected, but there was a point that the market thought that we were topping out, and the Fed was gearing up for a Fed pivot, as they said. Well, Powell came out and quickly shared that was not the case. They're going to foresee this thing going into 2023 and probably higher than what we originally expected as well. The market sold off dramatically yesterday, and still even more so today. However, it's been mitigated a bit, because what you're seeing now is two lines of thought. You have the people that are reactive, knee-jerkers off the Fed's raising rates, therefore yields are going higher, rates are going to go higher along with it. Sell, sell, sell. But then you're seeing another introduction of buyers coming in that are saying, actually, it's all smoke and mirrors. I believe the Fed, and I would probably be in this camp as well. I think it's psychology. I think the Fed has jeopardized their credibility to a place where they have to be the bad guy, if you will, and prove to the markets they mean business. And so, although that narrative has worked really well up until this point, you're going to get some cross current of basically investors that believe, you know what, I see the writing on the wall. This is not sustainable. Therefore, people are going ahead but coming in and buying at these levels because they see, rates are not going to necessarily go as high as they think it will.
Right. So when
That's mitigated that.
When Fannie Freddie comes out and makes some bold prediction that they think rates will be back in the mid fives by Q3 of 2023, is it based on that school of thought? Are they in that camp with us?
Yeah, I think recession is the word. The Fed is data dependent, and at this point, he's been batting a no hitter. Powell has been given a gift to be able to do what he's done, and right now the data hasn't manifested itself to say, it's marginally. There's been some toppiness in some of the inflationary reports. Inflation has subsided a bit, but there hasn't been a fall off in jobs. There hasn't been an increase of unemployment. The retail sales numbers coming out, that hasn't. Prior to that, the retail sales have still been strong. All these elements that the Fed's saying, this is what we're watching, hasn't come to realize yet. So with that, they've been given the ability to continue to say higher and longer, but the moment the crack emerges, and it usually happens just as much as Powell mentioned the word transitory, until he didn't, right? He marched that transitory mantra for as long as he could. And the moment he realized he'd gotten ahead of his skis with that, they did 100% 180. And I think the same is going to be true with this Fed trajectories. We can say we're going to 5.25, 5.5 terminal rate in the Fed fund rate, but there's a lot of people that believe the reason rates are going to come down is because the recession will arrive and his hand will be forced, and then the bottom is going to drop out.
Then we all go refinance our loans and load up on more houses, right? Get ready, Graham. Get ready, Aaron.
That was really good, Andrew. Thank you. That was great. I don't have anything else unless you have some more questions, Leah.
No, I think that about covers it. Okay, so let's end on this. I mean, I want to, as much as possible. I mean, we're low pressure. That's just our style around here. Like, the market is what the market is. We see opportunity in this market. We're urging people to buy. We're trying to flag. I mean, suddenly, Graham, I was just telling you this morning, we're about to hop off. I'll hop off of this call and get on another one with a team who's got, 10 deals that they want to feature today to our membership. And I've looked at all of them, and the returns are good. They're throwing in seller concessions. They're offering free property management. I mean, suddenly it's like we have negotiating power again as buyers, and I'm seeing deals that look good to me, but I'm constantly having to talk investors into seeing past a 7% interest rate. And so I'm just curious, what are you telling investors, who are really struggling to see past these interest rates? Aaron, maybe you have something. I know you talk with a lot of our members too, but what are you advising people to do and how to think?
Yeah, and I'll kind of go ahead and jump in. So my biggest thing that I always lead with is, especially with these investment properties, where by nature, you're most of the time going to have a smaller size loan when compared to that of a primary residence. So look at the dollars and cents. Don't get so infatuated on, oh my gosh, I'm at 7.5%. Well, how does that 7.5 compare to maybe a 6.5? Let's look at that monthly principal and interest. And it might only be, $70, $80, something that you could totally work with. So what I almost always lead with, share the rates. And then before we get that sticker shock, hold on, let's actually look at the dollars and cents here, do the math, crunch the numbers. And, depending on your situation, if you're wanting to put 20 or 25, maybe build up your portfolio, maybe have more equity, it's all case by case. But I can't emphasize enough, look at the bottom line numbers. Don't get so stuck on the actual rate, 7.5, 8. Look at that monthly payment, look at that cash flow, and see where that bottom line stands.
Mm-hmm. I think that's good.
And we do have to go through the education of what we're doing on this webinar now to explain why those points have to be paid to get to the table. Mm-hmm. They don't understand that. Well, my last time I did it was a year ago, and I had 0 points. This isn't a year ago. Okay, this is today. So yeah, it's ignorant till proven stupid, and we just make sure the ignorance, we get them smart about what's going on, and they feel a little bit more comfortable. Are there going to be 100% success rate when we do that? Like Aaron says, not really, not right now, but we are having some high success rates.
Yeah. How much should someone be thinking about timing their rate lock, or is that just stupid to even try to play that game?
Don't do that in this market.
We lock most of our loans on a 50-day lock. We do have an extended rate lock program for people that are building their properties, and a lot of it's in Florida.
Yeah.
That's still available, and I think it's an excellent program. And that extended rate lock can go out to a year. So we do have a lot of people that are already booked in for a year. When we hope that the builders can get it done by then. That's the biggest challenge right there.
Right.
So there's still a lot of delays, but
yeah, I had an investor reach out to me yesterday. She was going to contract a property that was under renovation, and it was very early on in its renovation process. So the team was kind of estimating a closing date, maybe 60 to 75 days out. So just past, a traditional rate lock program. And she was kind of going back and forth on whether or not it would be wise to go ahead and lock and then pay the daily, the daily rate lock extension rate to just try to, hedge her bets. And I was curious, I knew I had this call with you guys today, and I was curious what you guys would say about that. Is that something we should be considering, or is that gambling?
Aaron, you're better at this than I.
Yeah, and Leah, we might have been speaking with the same client yesterday as well, because I had a good conversation with that and kind of shared my thoughts. And at the end of the day, it is a slight gamble, because here's the catch. We have a 50-day standard rate lock. If we're not talking the extended rate lock program, we can extend that 50-day lock a max of 30 days once it expires. It's a marginal cost, but it does add up per day. So on that one, where it was, okay, we're, we're probably at that 60, 70-day mark of when the property is going to be completed from now. So if we lock in at a 50-day, add an additional 30 days, kind of worst case, we have an 80-day, which is, gives us an option. We can secure the rate today, but the only risk there is, if the build drags, if the rehab drags,
right,
you get past that 80-day. Now, no telling what the market is going to bring. Right. Could be a potential kind of, relock adjustment as well. So if at all possible, we always want to avoid that, because, you can't telling
commit
what's
to that
happen.
Indefinitely.
If, that one was almost a little bit too far outside my comfort zone, where it was right on, it's going to be ready maybe 70, 80 days from now. If we have one that's closer to, this one's going to be ready 4 weeks from now, well, we can fit that in the 50-day lock. No problem. So it's all case by case. But like Graham alluded to, we're, here to kind of walk through with every borrower and give them our thoughts, give them our suggestions. And, the great thing about RealWealth is everyone is so kind of just on the same page as far as communication is concerned. So getting answers like that, looping everyone into a same email or phone call or conference call, we can get those answers. We can get the best guess estimates. That way the borrower's in good hands at the end of the day.
Right. This is why we come to you guys. I love it. I always try to relieve people's fears. I'm like, look, you don't have to be the expert in every aspect of this. Lean on the people who are. Pick up the phone, pick their brain. It's still investing at the end of the day. So there's no guarantees. There's no absolutes. We're all making our best informed guesses to make the best financial decisions that we can. But to Andrew's point again, the parameters of that are changing at warp speed these days. So it's a very difficult space to play in. Well, guys, thank you so much for hopping on a quick call with us today. If somebody wants to get in contact with you, Graham, what is the best way for someone to do that?
Always call my toll-free number at 855-326-6802. If you miss me, please leave a message. I'll call you right back.
Awesome. All right, guys. Thanks. Good to see you all.
Thank you.
Thanks, everyone.
Sure.